Dear ladies and gentlemen, welcome to the Baltic Horizon Fund webinar session. We are going to introduce the fund's third quarter results. My name is Kristin Vedat and I am the Communication Manager at Baltic Horizon Fund. I am pleased to introduce today's host, Baltic Horizon Fund Manager, Mr. Tarmo.
Hello, this is Tarmo Karotam. I'm the fund manager of Baltic Horizon Fund, and I'm not sure if everybody heard Kristin here, so let me just give a quick recap of what is to be expected from this webinar. First, then, just it will be a short introduction of the fund and also the recent history, what has been happening with the fund during 2016. Then we will go into the portfolio and into the Q3 results, and then we will end with a few sort of a stress test analysis. So let me just then start. Baltic Horizon Fund, what it is? It's a real estate investment fund focusing its investment into Baltic capital cities, Tallinn, Riga, Vilnius, predominantly in office and retail assets. Today, the portfolio of 7 properties has a net leasable area of more than 70,000 square meters, has a vacancy as of end of Q3 around 2%, and what is the target of this investment fund? This investment fund aims to pay out regular quarterly dividends to its investors from the operating proceeds from its assets, from the rental activities. At the same time, create value from the properties by indexation of rents and certain value-added activities where possible, such as building expansions or similar. The fund is planning to pay out at least 80% of the operating proceeds. That's the dividend policy. Also in the fund rules, it is required the management to make these payouts from the rental activities. We have a target of growing this fund into a 1 billion euro structure over the medium to long-term period, and we are looking to add efficiency into the structure by growing the fund, but at the same time managing the risks, distributing them across different assets, and diversifying the tenant mix and financing partner side as well. Now, what has happened in 2016? Just a quick recap before we enter the Q3 results. We have had a portfolio of 5 assets beginning of this year, and with the investor base that we had back then, 27 investors, we came together and decided to make this fund evergreen. And the reason for that was that the fund investors were reluctant to sell the portfolio in an open market to other real estate buyers in the Baltics. So when discussed and the decision was made in March, the plan was then to not only make the fund evergreen, but to list it on Tallinn Stock Exchange and have a dual listing in Stockholm Stock Exchange at the end of the year. With the proceeds of the IPO in Tallinn Stock Exchange, we were able to make 2 additional acquisitions. We closed one acquisition just days after listing the fund in Tallinn, and that was the G4S headquarters, and then also closed the second office building in Riga, at the end of August. So here I would emphasize that September results reflect the results of the overall portfolio in full. Also, what we are planning now is additional capital raise and listing in Stockholm, and this is currently an ongoing process. We have also developed a pipeline that we would invest to with the equity that we are planning to raise now at the end of November. This is the slide about the management of the fund. Below is the management board of the management company Northern Horizon here in Estonia. The fund is an alternative investment fund licensed here at the Estonian Financial Supervisory Authority. The fund has a depository bank and administrative support both from NHC's finance team headed by Ausra and also Swedbank. So Swedbank is a depository bank. Algis Veitikunas is responsible for the pipeline, and myself for fund management in general. We have elected a supervisory board, Raivo Vare being the chairman, and here we have gathered really the expertise from all of the Baltic markets from different areas. For example, Per Möller has audit background, Andris has investment background, Per Möller, also Lithuanian background, Andris Latvian background, Raivo Estonian background, and the newest board member we had elected in the recent investors meeting was David Bergendahl. He's also an investor in the fund, but representing the Swedish investor base as well. David is also a member of two Stockholm-listed property companies, so we welcome his expertise into the structure from that side as well. Currently, the biggest investor in the fund is Swedish Church Pension Fund with slightly less than 20% stake. The fund overall has approximately 300 investors, and the majority of the investors have a stake between below 1% or 2-3%. So the investor base is already quite diverse. Now into the portfolio. We have 7 assets. Our investment strategy is to invest into Baltic capitals and invest into retail and office segments, into competitive buildings that compete in each of their micro locations. So, for example, in the office segment, we have 3 properties: Lincoln Office Complex here in Tallinn, anchored by Swedbank and the State Information Authority on a long-term lease. Then we have G4 headquarters, G4S headquarters that we acquired in July. The main tenant there is, of course, G4S. They had planned a long time their own building, which they finally were able to move into in 2013, and we believe in the long-term success of this investment, with G4S being there also on a long-term lease agreement. Then Upmalas Bureau is an office building in Riga, which houses SEB Global Services and Bosch, Johnson's and Cabot call centers. So again, a good example of office building which is housing nearshoring tenants from the Nordics that have brought their back offices to the Baltics. Their shared service centers. Both of these properties are considered to be rented out at an average market rent. The portfolio itself has an average rental level of 11 euros per square meter per month. We consider this as a sustainable level. In the retail segment side, what we focus on are CBD located shopping centers such as Europa, but also neighborhood shopping centers like Sky and Domus Pro. Why? In Sky and Domus Pro, there is an immediate catchment area around the building, living in the apartment houses, and such investments, these neighborhood shopping centers, have proven to be quite resilient also during crisis, because people still need to shop for food. The anchor tenants there are traditionally on a very long-term lease. So these are the type of properties we have liked, and also we are looking for in the future. Europa Shopping Center is right in the heart of Vilnius. It is a dynamic shopping center with more than 70 tenants, and we're happy to see the Vilnius Central Business District developing very rapidly, so more people as well coming to the areas to work and shop. And in addition, we have also Coca-Cola Plaza, which is a cinema building having some retail on the ground floor. That is located as well in the heart of Tallinn, currently as well on a long-term lease, and we see quite a lot of potential in that building in the coming years in terms of potential to expand. So this is a summary of the portfolio, just to give you an idea before we go into the results. A few more words about the main tenants. The largest tenant is approximately 12% of the portfolio's annualized rental income, and we consider our tenants very strong international names, but as well local names. Some of them sustainably being in the markets for many decades already. And what we do is we manage our leases so that the distribution of their terms is not all in 1 year. So that that means diversifying this tenant risk as much as possible. Now, a summary of risks for this fund. We have identified for this purpose 3 key investment risks. One is the operational risks, meaning that can we get and can we acquire properties that are new, require low capex, and house also sustainable long-term tenants. We pick our buildings or also always looking how they are positioned in each micro location. So how does this specific office building or shopping center compare to other shopping centers in the area or in the city? We look at where tenants would like to move, where tenants are happy, what are their expectations, and so forth. We make our investments based on those trends. Now, financial risk is also a key risk for this fund, meaning that can we keep our cost of debt low? The financing partners that are operating in the Baltic region are approximately 10 partners. We have bank loans from four of the different banks for this portfolio, and we are looking forward to diversifying those partners as well. It is expected that the cost of debt will remain in the euro area and also in the Baltics low for the coming years, and what we are currently working on is negotiating some of the loan agreements to make them even longer term. And a quick summary of the liquidity risk, meaning that how liquid is such an investment, and we do have an ambition with this fund to become actually the most liquid security in the Baltic markets. So we have a strategy now. We have had this fund listed in Tallinn for the Baltic investor base predominantly, but also investors that would like to hold their units in euros, international investors. and we're going forward with now a public offering in Finland, in Sweden and Estonia, and potentially also in Denmark, to even further diversify the investor base. So the amount of investors we're looking for this fund are definitely more than a few thousand at the end of the day. We think that real estate as an asset class is as well quite well perceived and understood by a general public, investment public. So and with the properties that we have acquired as well, we welcome all the investors to analyze them specifically to see the potential and risk of each property. So now into the results. The main difference in this comparison to last year is that we have completed. We have an increase in net operating income, and this is due to the properties that were acquired now in July and August, but as well we had an expansion of Domus Pro completed at the end of June this year. So that was a expansion project which we started last year, financing the construction, having had two of the tenants which pre-leased the whole second stage 100%, and it was finally opened. Hansa Tiles and Fitness Gym opened their doors. So that has contributed positively to the rental income. On these lines, expenses, reimbursement revenue, and cost of rental activities, you can see how much of those rental activities related to the properties are being remunerated by the tenants. So there is a small part which is still uncovered by the lease agreements, but we're working very hard to have these numbers being equal, so that the fund and its investor base will not cover those costs related to operating these buildings. Also, there were listing costs in the IPO that has also been charged now in Q3. And what as well we did at the end of Q3 in September was a revaluation of the properties. This was done because last valuation was in 2015 December, and as we were going forward to the secondary purchase offering and Stockholm listing, it was only diligence to ask professional advisors such as Colliers and DTZ to revisit these properties and value them based on the latest rental results, forecasts, but as well the change in small change in discount rates. We ended up with a result, I think, with a very sort of expected result, so that the portfolio had increased over the 3 quarters by approximately 2.5% in terms of value. In money terms, we had recorded a profit of 2.8 million euros for the third quarter. Income tax charge in this case reflects the deferred tax which had been recorded due to these valuations. So majority of that amount is a non-cash flow item in the books. This is a snapshot of the balance sheet. A few words. We were able, with the amortization schedules and some of the loans and the revaluation of the properties, to decrease the portfolio loan to value to less than 54%. As you may know, the target leverage of this fund is 50%. All of the new properties that we bought during the summer, we bought them at 50% loan to value, so we're still slightly above 50% at the portfolio level, but we're working towards having that figure to be closer and closer to 50%. Weighted average cost of debt today is actually 2.1%, and I think that's a good level. I do hope that we will see some improvement in that cost in the coming period, but this is again part of the fund management activities to renegotiate best terms for the fund and for its investors in all accounts, including loan agreements. As well, we are now, since we are a listed and evergreen fund, and we don't have to liquidate all of the assets when the fund term comes, then we are prolonging, since we don't have a term, we are now prolonging our loan agreements to 5-7-year periods. So current weighted average maturity of more than 2 years, we hope to prolong that as well in the coming period. So I think a few words about the NAV. NAV is being increased on a monthly basis, has been increasing due to operating cash flow income, and which you can monitor very well on our website. And in September we had then the valuation of properties, which also ended into affecting the NAV positively. I think this is an important slide, just to zoom into September results, because September, as you can see, the rental income is where it should be for the portfolio, as the portfolio is in full swing in September. In July, we bought the G4S. At the end of August, we bought Upmalas Biroi. So all of these properties were generating full income, yes, in September. If you look at the net rental income figure, then yes, we achieved a rental income of 734,000 for this month. In the expenses related to the IPO line, those are the invoices that were still to be covered, after the IPO, related to the cost setting it up. And administrative expenses are fund management fees in major part. So and you can see that overall, with the valuation gains in September, we recorded a profit of 3.4 million euros. Now, if you remove these valuation gains, then profit before tax, meaning that also financial expenses have been netted from this profit, which are interest costs. Then we arrived at a monthly profit from operations, which is 486,000 euros, which is approximately 8.7% to the annualized market cap. So I think we're well in line with our strategy to deliver investors a return of 12 to 15% annually, and of which dividends would be approximately between 7 to 9%. As you also know, we paid out the first dividend in October now as a post third quarter event, which was 2% of the market cap. So as you can see, our business is really coming from operating these buildings that we own in the portfolio. We have a strategy for each of the buildings. We know the rental agreements. what are the structure of these rental agreements, when are the terms coming. We have a strategy for each of the building, how long to hold it and when to sell it, or when to make expansions if in case possible, and so forth. So this is really the heart of the business, generating rent from these properties. And on the other side, we have the cost of debt, which is decreasing the cash flow. But I think right now the cash position of the fund is also very strong, being at more than 3.2 million euros, as you can see from this slide. Then this slide sort of gives you the sensitivity of the portfolio, and the two ways how to look at it: the vacancy rate versus interest rate. We are, as you know, the cost of debt is around 2.1% today, and the vacancy rate of 2%. So here you can see where we are today. The stress test for this to become zero, for example, is that for us to have zero sort of return, that needs 30% vacancy in all buildings and the interest rate to increase to 5%. In regards to the interest rates, I think the expectation still is that they will remain very low for some time, but they will start to increase at some point, most likely gradually. We try to tackle this potential increase in interest rates by having long-term loan agreements with hedged, that means fixed cost of debt. The second graph shows the annual rental growth versus the interest rates. So we do see in many of our properties more potential than rental growth based on the indexation. So I think indexation, all the rental agreements that we have indexation clause in there, and indexation normally based on the CPI of either European Union CPI or the local CPI. So that is expected to be between 1% to 2%. However, we do see in some of the properties more potential than just the inflation number in terms of rental growth. We aim at having a 3% rental growth potential in the portfolio overall. But this gives you a good idea of where we position ourselves in the with the assets and towards total return that we would like to deliver to our investors. I think this is actually the general update of the portfolio and its results in Q3. As maybe an ending remark before any questions, I would like to state that yes, we are in the process of public offering now in November, and we are looking to make investments here in the Baltic capitals with yields between 7 and 8% still, and also having the banks finance these investments at strictly 50% LTV and at the low cost, as low as possible. This concludes my presentation, the first part, so I'm happy to receive any questions. Okay, I have a question. Thank you. The question is there estimate of negative effect on profits due to higher debt costs? And it has been mentioned that current average debt maturity is 2 years, and it is expected to be lengthened. The answer to this is based on the negotiations with the banks. At this point, I don't see the cost of debt increasing. Even for the potential new acquisitions, the cost of debt still has rather potential in this portfolio to decrease, as the properties are attractive also for the banks to be financed, and banks are very selective which properties they finance here in the Baltics. So we have had very good cooperation with these banks, and towards these properties we don't expect them to increase the cost of debt. Now, if you look at it on a, let's say, 3 to 5 year perspective, then yes, currently the target is to renegotiate all of these loan agreements that we have. We could only have, we can only start we only were able to start doing this after the IPO, because then the fund became evergreen. So we are in the process. Hopefully by next quarter we will be able to update you on this process and show the debt maturity to be now longer than 2 years, which is currently in the portfolio. As I mentioned, the latest 2 acquisitions were financed with 5-year money and the fixed cost of debt. I have another question. Are you looking to enter any new cities other than Riga, Tallinn, and Vilnius? The answer to that is no. We do have a lot of beautiful cities here in the Baltics, but unfortunately, the golden rule in real estate value growth is that where you have more people, then that's where the value growth will be concentrating on, and the potential in such locations is the highest. We do see, the demographics and the population growth to be at least at the same level, and also with a slight increasing trend in the Baltic capitals, in Tallinn, Riga, Vilnius, where the population has been increasing. So we focus on Tallinn, Riga, Vilnius also because of this, and that's where we see the properties being also the most liquid in case we would like to sell any of these portfolio properties in the future. Another question, thank you. I will read it. Swedish retail market overview. Is there any REITs or other real estate funds operating? Is it reasonable to expect a significant price increase in Tallinn Stock Exchange as Swedish investors will be introduced to a reliable investment of 8 to 9% returns? This is difficult to answer. I could only say that as the fund manager and with the team, we'll do our best to have our investors understand the portfolio and what is to be expected from this portfolio. The cash flows, are they that you would have confidence in this portfolio when investing. And in case we do deliver on our promise with these quarterly dividends on a regular basis, I think that will create a very positive view towards our fund, even more positive. So that may result in a price increase. It is also a good question in a way, because it points out that the returns investors get in Sweden are lower. And they do invest, they have invested, many Swedes have invested into this fund because the fund offers them, let's say, comparable risk that we have, for example, Swedish and Nordic tenants in our buildings as well. Nordic banks are financing our investments, as so, and the buildings are of a very good quality. So just the geographical location is different, but so is the return potential. The yields are much higher. So it is an attractive investment case for Swedish investors, but it's difficult for me to forecast any movements in share price. But as I said at the beginning, we'll do our best to make sure that our investors are happy and their investments successful. I have another question. There are many property funds operating now in the Baltics. Do you feel competition with other funds when looking to buy a new property? Are the prices increasing as many funds are looking to buy the same property? The competition, yes, is here. We have 4 or 5 similar investment sort of funds that target their investments in the Baltics. However, every one of them have a slightly sort of different strategy, and some of them invest into smaller cities, some are invest into other segments than retail and office. It is also a question, since many of the other funds, actually most of the other funds, have a term. They are not evergreen as our fund, and at some point they would need to sell their assets. So what we expect now in the coming years is for some of these funds that started in 2010 and 11 to start selling their assets, but unless they are able to prolong them. At the same time, yes, there is always competition, but we do take pride in entering into negotiations also with a strong name, Baltic Horizon, and we've had quite a bit of success of just being a professional partner to the seller, to be able to win some proposals, some investment cases, even though our price has not been the highest. So we aim to uphold that professionalism and confidence that the sellers have in us as a buyer, because worst thing that any seller wants to do is to waste 3 to 6 months on a potential sales process where the sales will not then take place at the end. So competition is there, but I can give you another story. When we bought the G4S building, we made a bid. Was actually September last year, and our bid finished 3rd best. And the seller came back to me in November saying that the other bidders, ended up being not professional enough. So we entered into negotiations again, and we agreed the terms. So it is not so the case that all properties have always a lot of buyers, but of course it depends on it's a lot to do with timing. Any more questions? Another question: are you considering residential market? The answer to that is also no. Residential market in the Baltics is not attractive for us as an investment case. Since we are in the business of buying properties and renting them out on a long-term basis, we consider the rental market in residential segment more riskier and with a lower return. So so yes, we will not buy residential objects. Our strategy is to continue acquiring very established either CBD or neighborhood shopping centers that have an immediate catchment area, and then established office buildings which are competitive with their construction quality, which have long-term leases, strong tenants that always don't want to look for ways how to move around the city to find new premises. And our goal is to really have good tenant relations to be a very strong cooperation partner for these companies on a long-term basis. Maybe I would add one comment about the shopping centers and the growth in online trading. Yes, this is a trend that we are also monitoring, and the online trading is increasing, as you all know. But we don't feel that that means that all shopping centers will die out. It will affect, it actually has already affected some segments, specifically electronic stores and furniture, for example, interior design. A lot of those trades have now moved online. But in terms of services and food, food is also actually being now delivered more and more through online orders, but the pickups are still made at these grocery stores. But we do manage these types of risks by inviting more restaurants, for example, into our shopping centers, like we did in Europa, a gym, so more social activities. That's where we believe the overall shopping segment is moving, also in the Baltics. Another question: are there any lineup acquisitions for second IPO as there were in the IPO? Yes, there are. There are several acquisitions that we have been negotiating since the summer. We want to be in a position on the 1st of December to call in the money and invest that money right away into the pipeline. I can say that we have less focus in Tallinn at the moment, and more focus on Riga and then also some Vilnius properties are attractive. Okay, well, that seems that that's all the questions there is right now. I welcome you once again to go through our third quarter report. In case of any questions, do write me, and also get acquainted with all the other materials we have on our webpage. And most of all, I would welcome you all to go and visit and touch the buildings that we have in this portfolio, in order to get a good sense of their micro location and their situation in the real estate market in each of the cities where they are located.
Dear ladies and gentlemen, it looks we have covered all questions so far. On behalf of the Baltic Horizon Fund, thank you all for joining the webinar. The webinar recording will be available on our website, baltichorizon.com, and on the Nasdaq Baltic YouTube channel webinar playlist. You will also receive a follow-up email. Thank you and have a good day.